The Canadian dollar struggled to generate momentum after the central bank turned hawkish and pulled the trigger on a 3/4-point rate hike, lifting benchmark rates to the highest they have been in more than a decade. The Bank of Canada, BOC, raised interest rates by 75 basis points to 3.25%. This is what economists had expected prior to the announcement. The overnight rate is now the highest it has been since the Great Recession more than a decade ago. The bank rate rose to 3.5%, while the deposit rate climbed to 3.25%. BOC officials conceded that more tightening is necessary to curb inflation, particularly since the core inflation rate, which removes the volatile food and energy sectors, increased in July. Given the outlook for inflation, the Governing Council still suggests that the policy interest rate will need to rise further. Quantitative tightening is complementing increases in the policy rate. As the effects of tighter monetary policy work through the economy, we will be assessing how much higher interest rates need to go to return inflation to target. The Governing Council remains resolute in its commitment to price stability and will continue to take action as required to achieve the 2% inflation target, policymakers said in a statement. Canadian economic data has been mixed over the last week. According to Statistics Canada, the second quarter growth rate advanced at an annualized pace of 3.3%, up from the 3.1% in the first quarter. But it did fall short of the 4.4% consensus. On a quarter-over-quarter basis, the GDP growth rate was unchanged at 0.8%. The GDP expanded just 0.1% in June, but it slipped 0.1% in July. In addition, the S&P Global Manufacturing Purchasing Managers Index, PMI, slumped to 48.7 in August, down from 52.5. In July, anything below 50 indicates contraction. The Canadian real estate market continues to be in a downturn as building permits tumbled 6.6% in July, down from the 1.5% drop in June. Economy. STS anticipated dip of 0.5%. On the trade front, Canada's trade surplus slipped to $4.05 billion in July, according to Statistics Canada. Imports eased to $64.2 billion, while exports also fell to $68.25 billion. The Canadian bond market was mixed following the central bank's announcement, with the benchmark 10-year yield down 4.5 basis points to 3.154%. The one-month bill added 6.5 basis points to 2.765%, while the 30-year bond dropped 3.4 basis points to 3.128%. The USD-CAD currency pair declined 0.24% to 1.3184, from an opening of 1.3154, at 14:07 Greenwich Mean Time on Wednesday. The Euro-CAD surged 0.35% to 1.3072, from an opening of 1.3026.